when we're talking about crowdfunding, what we're basically saying is we're shouting from the rooftops on the internet, wherever, to the crowd as a whole. We want you to invest in our deal.
Welcome to the Multifamily and More virtual mastermind. I am your host, Jamie Gruber, along with my lovely, beautiful, attractive co-host, Benoit Malige. Say hi, Ben.
Hi.
That's all Ben
How are
said.
you, Jamie?
That's his entire contribution for this
And
entire
that is it.
event.
Thank you very much.
Ben says hi, and then he fades away. So I'm excited tonight. We're obviously getting started a little late, so I'm going to dive right in with our incredible guest, Jillian Sidoti. Jillian is one of the leading experts, if not the leading experts, on the Regulation A fund, has created many of them. She's an author, a speaker, an educator, and if we get to it, had a little career in the music industry from what I understand, and maybe we can talk through that.
Yeah.
Jillian, welcome. Glad to have you.
Thank you so much. Thank you for having me. I really appreciate it. I apologize for being so late. We had all kinds of unfortunate difficulties, but I appreciate everyone hanging around. I know it's if you're on the East Coast, it's late over there. So anybody who works to educate themselves after working hours is awesome in my book.
I think people are happy to do something like this, given the corona, like get away from the coronavirus, from all that stuff. You got to be virtual everywhere anyway, right? So maybe
It works. So no problem at all. Thank you so much for coming on the show. We're really excited to learn about some really exciting stuff. We're going to talk about your background, about a bunch of things like that. But let's I guess jump right in. Let's talk about crowdfunding. So when we talk about crowdfunding, people think of Kickstarter, people think of GoFundMe. You're known as the crowdfunding lawyer for real estate. So what is crowdfunding for real estate? What is crowdfunding for a real estate investor?
No, that's a great question. And so really, honestly, there's two different types of crowdfunding. There is crowdfunding for, well, actually, I'll take that back for a second. There's three different types of crowdfunding. There's crowdfunding that is like donation-based crowdfunding. For example, GoFundMe is crowdfunding. That term is used a lot for GoFundMe, but that is not crowdfunding and what we're going to be talking about. And then there's crowdfunding, like you mentioned, Kickstarter and Indiegogo, which is where you're getting like a product or a credit or a bumper sticker for, donating. Like, for example, I donated years ago on a Kickstarter campaign so they would build the Nikola Tesla Museum in New York, in Buffalo, New York, or wherever Niagara Falls is. And, I was supposed to receive a bumper sticker in exchange for my donation to the Nikola Tesla Museum. I don't think I ever got that bumper sticker. I'm going to have to find out about that. But then there's another type of crowdfunding, and it's what we're talking about, which is raising money in exchange for a promised return. And you're raising that money from the crowd. So there's several different ways you can do this. And it just really depends on how much money you want to spend on legal fees and how many types of investors you want and how much money you want to raise.
Beautiful.
Jenny, are you still here?
I am. Yeah, I apologize. Did it pop away? There we go.
No, you look frozen.
Yeah. No, sorry. It something popped up on my screen. So, all right. So that is crowdfunding. Mm-hmm. So I get the overtone. So how does that play into what you do on a day-to-day basis from a Regulation A?
Yeah. So what we help real estate entrepreneurs do specifically is go out and write documents so that they can legally go out and raise this capital. So for example, if you're talking to an investor and you want them to give you money, I break it down like in a very easy format. What I say is that what you have an obligation to do with those investors is to give them something called the 3 Ds, which is disclose, disclaim, and details. So you have to disclose all material facts, disclaim any liabilities, and give them all the relevant details to investing. So we want them to know the risks associated with investing. We want them to know where their money's going. We want them to know what they're investing in. We want them to know when their money is going to come back to them, what their potential returns might be. All of those things we want them to know upfront, and we usually provide that in some kind of offering circular. You might hear it called a private placement memorandum. You might hear it called a disclosure document. In the case of Regulation A crowdfunding deals, we write an offering circular that gets approved by the Securities Exchange Commission. So whatever the case is, what we're doing is providing the 3Ds to our investors and letting them know exactly what it is that they're investing in, what they're getting into. And so we help provide those documents. And then we also provide the documents for, hey, this is how we're going to run the company. We're running the company this way. And for example, an operating agreement. Most real estate entrepreneurs use an operating agreement because they're an LLC. And they use an operating agreement to tell the investors and themselves how the company is going to run. And that's really the legal document that glues everybody together.
Interesting. All right. So crowdfunding, from a standpoint of what you do, is there any difference across any of the different entities that you might have? 506B, 506C, Reg A. Is crowdfunding a term that can apply to all, or is it specific to one versus the other? I want to make sure I'm clear. And by the way, for the audience out there, please drop questions in the chat and we'll pull them out as we go. But I'm curious about that. Like, I'm trying to get that distinction on what that is versus, or not versus, but with all the different funds you can have.
Yeah, no, that's an excellent question. So crowdfunding is like a term of art more than anything else. But then I'm going to talk about it from a legal perspective as well. So yeah. Like I said, we used crowdfunding to describe GoFundMe, which isn't the sale of securities, and all those numbers and letters you just talked about don't apply. And then we talked about crowdfunding from the perspective of Kickstarter, and those numbers and letters don't apply there either. But when we talk about the laws that I like to call the buckets, where are we talking about crowdfunding applies? And so I said there's two different ways to think about it: the actual way we do things and the way the Securities Exchange Commission looks at things. So when we're talking about crowdfunding, what we're basically saying is we're shouting from the rooftops on the internet, wherever, to the crowd as a whole, we want you to invest in our deal. Then it kind of matters in the eyes of the law. In those buckets I'm talking about, it matters who gets to invest under those particular circumstances. So you mentioned 506B, 506C, and Regulation A. And I'm going to actually step back for a second and explain that there's four buckets. There's four basic buckets under the law. The first bucket is actually crowdfunding, and it's Regulation CF. And I'll tell you right now, most real estate entrepreneurs do not use Regulation CF. I will say that I actually discourage most real estate entrepreneurs to not use Regulation CF at all, because to use Regulation CF, you need to find a registered crowdfunding portal, which is like a company that is registered with an organization called FINRA, and they're registered with FINRA as a crowdfunding portal specifically, and they have to follow these certain rules. One of those rules to allow people to be listed on their portal is that they can only allow their entrepreneurs or their entities, whatever it might be, they can only allow them to raise up to $1 million. And that's it. $1,070,000 is all you can raise on a registered crowdfunding portal. So Regulation CF doesn't work for our real estate entrepreneurs who are trying to, raise money for their $5 million multifamily property. It just doesn't work. Yeah. So, but let's put that aside for a second. Let's talk to our single family guys real quick who are out there maybe listening to this, and they go, well, $1 million, awesome for me. But let me bring you back to reality for a second, because the average Regulation CF on regulated crowdfunding portals, the average investor on those portals only invests $250 per person. So we're talking like a real difference in the capital
Yeah.
that they're raising. So we want to be, super mindful of that.
Yeah. I'll be honest, you had me at FINRA. When you said FINRA, I didn't care about the $1,070,000, whatever that was. I was like, I don't want that. I don't want FINRA.
So, and they're a nasty organization, by the way. You never want to be called by them. But, but with that being said, so we have regulation crowdfunding. That's one bucket. Then we have 506B as in boy. And I want everybody for a second to imagine that the law is a tree. And I'm going to try not to put your audience to sleep.
Not at all.
I promise I will do my best. So if we think about the law as a tree, the big law, the law of the land when it comes to securities is the Securities Act of 1933. This is important because it governs all of us as a country on what we do. So what that rule says, or that regulation says, is like, look, if you are raising money in this country in exchange for a return on investment, then you must either register those securities or have an exemption from registration. So if we see up here our tree 33, under that we have regulations, and two of those regulations are Regulation A, or actually all three, Regulation A, Regulation D, and Regulation CF. So we've talked about Reg CF. We're going to push that off to the side, and I'm going to focus on that middle one, Regulation D, right now. So Regulation D is an exemption, and it says, look, if you follow the rules under Regulation D, you do not have to register your securities. So there's two rules, 506B and 506C, which were two of them that you mentioned. 506B, we cannot crowdfund. 506B says you cannot use general solicitation. So at the beginning we said, you can shout from the rooftops and say, who wants to invest in my deal? And that's what we think of as crowdfunding. And 506B says, no, you cannot do that. But 506C says you can do that, but only with accredited investors. And those are people who make $200,000 a year as an individual, $300,000 a year as a married couple, or $1 million in net worth exclusive of their primary residence. So that's our Reg D, Rule 506, B, C. C, we can crowdfund. B, we cannot.
Got it.
Then we have A.
Yeah.
So Regulation A then allows us to raise $50 million from any investor. We can crowdfund. We can do whatever we want. Well, within reason, within the letter of the law, we can do whatever we want. And then, but what do we have to do? What's the trade-off? Because of course there's a trade-off. And the trade-off is that we actually have to take that to the SEC and get approval for that Regulation A before we can go out and raise capital. Okay.
So why, other than the apparent timeline that it would take, because I'm sure you go to the SEC and say, I want a fund. I doubt it's the next day that you get that. So I'm sure it takes a while. Yeah. But other than that, when you describe it, 506B and C are under the Reg D exemption, I guess you would say, and my apologies if I'm saying that inappropriately. And you can or can't crowdfund, I get that. But A sounds like, you're kind of like, do what you want to do almost, because you're filed and you're ready to go. So why wouldn't everyone file just for a Reg A fund? Why wouldn't they do that?
The thing is about crowdfunding, and I got a copy of my book here, and you don't have to buy it. I will send it to everybody. Everybody can have it for free. Oh, so
cool. Thank you.
Just send me an email and I'll get it out to everybody. But the thing is, and one of the things I talk about in this book, The Crowdfunding Myth, and why I want you guys to read it, is that crowdfunding is not a magic bullet, and neither is, in Regulation A, crowdfunding is not a magic bullet. So what do I mean by that? I mean, you can go out and shout from the rooftops, hey, I want everybody to invest in my deal. Please invest in my deal, and have that latitude with Regulation A. It doesn't mean it's going to happen. You still have to get people to know, like, and trust you prior to them throwing money at you. I mean, that's true of anything in life, and it's really true when it comes to investing. Mm-hmm. So with that being said, if you look at Regulation A and what it takes to get it approved with the SEC, I'll tell you, it takes two major things that a lot of people don't have, which is time and money. And if you don't have 4 to 6 months in time and $75,000 in cash to get this going, then you should not be doing a Regulation A. And actually, I should say a third thing to that: 4 to 6 months in time, $75,000 in cash, and a crowd to support it that you already have built up that knows, likes, and trusts you. And to this end, if you look, and I don't want to be name dropping, but if you look at my most successful Regulation A's, it's like people like Grant Cardone, who had 6 million followers on Facebook before he went out and started doing Regulation A. He already had a group of people who knew, liked, and trusted him.
Yeah. Yeah, that makes sense. And it's okay to name drop. That's a good name to drop. Everyone loves Cardone. That's awesome. All right. So back to so most folks probably on this call, me included, would be in that B or C kind of range.
Right.
So give us a sense of between those two, I don't know, why go B, why go C, I guess. What's the benefit or detriment to an investor doing one or the other?
I swear to God, I'm going to go trademark this phrase: investor alienation, right? Okay. So here's the thing, like under 506B, you can take up to 35 sophisticated but not accredited investors. And what a sophisticated investor is, somebody who's not accredited, but understands the risks associated with investing, like understands that they could lose all their money, has taken maybe some real estate classes before, has invested in other deals before, understands those things. Under C, it's only accredited investors, and you have to verify that they're invested, right? So verified that they're accredited. So here's the thing: if your dear Aunt Sally, who knows a little bit about real estate and has been your biggest fan since you started your real estate investing company, and even lent you $100,000 for you to get started 5 years ago, and now you're starting a fund and you're writing that fund, but dear Aunt Sally is not actually accredited. Oh no, she only has a net worth of about $900,000. Guess what? You cannot take dear Aunt Sally's money if you do a 506C. So that's what I tell people when they're trying to decide, should I do a C or a B? I tell them, you really, really, really need to look inward and determine, and outward to your current group of friends and family and associates and people and say, what is the lay of the land here? And am I going to have investor alienation if I do a 506C? So I encourage people to really look at that prior to saying, like, well, I have to advertise. No, I'll only take accredited investors. If you commit to that, are you going to be cutting out really important people like dear Aunt Sally?
Got it. That makes sense. And I think I've even seen where, excuse me, as an investor sort of progresses through their career, 4, 5, 6 deals in, their net worth is increased. They're now hanging out with people of that net worth level. That's when they first do a C. It seems anyway. Like that. Now they're going to go a full accredited investor fund. So it's a fair point. Like, look around. Is everybody a dentist, or is everybody working class that wants to invest a little bit of their IRA or whatever the case?
Yeah, no, I mean, I have some really big funds. I had a really big fund of mine that only takes accredited investors call me the other day and say, my sister really wants to invest. I'm like, okay. Is she accredited? Right. No, then she can't invest. I mean, I literally just had that conversation last week with somebody. And that's what you end up doing when you take on 506C. That's not saying that you shouldn't do 506C. I'm saying you really want to analyze, is this the right choice for me prior to going out and doing it?
Okay. So I want to take it one step back. Oh, Ben, go ahead.
Okay. No, sorry. I wanted to, since we kind of funneled into the 506B, I wanted to talk about the 506B a little bit more, since it seems to be appropriate for most people here in this group. What makes a sophisticated investor? How do you prove that you have an existing relationship? Can we talk about these things that are important for the SEC?
Yeah. It's real simple. Before you make an offer to them, provide them with an investor qualification form that asks them, are you accredited? Are you sophisticated? What makes you sophisticated? And if you get that will establish a substantive pre-existing relationship, because the definition of substantive pre-existing relationship is intimate knowledge of one's financial ability to invest. So if you have it on a form that they signed and said, this is the truth, that establishes that.
Okay. Rather simple.
Yeah, pretty simple. We have a couple questions that are popping in, but I wanted to ask this real quick just to kind of get at this. But when do you need to consider setting up a fund for raising capital? So I'll give you the example. I want to buy this property. I've got my mother, my father, and my aunt who are willing to give me money to do so to invest in this property. But they're not going to have any role. They're just giving me the funds to do this. So I think technically that's a security, right? So do I need a fund, or am I able to just sort of, no
okay,
big
so
deal?
they're giving you funds. Is it for a specific property, or is it, I'm sorry, I think I might have missed that part.
Yeah, no, for a specific, I've got this property. I want to buy this property. Mom, dad, and Aunt Sally are going to give me the money to buy it, but they're going to have no role in it.
Okay. Yeah. Okay. So here's what a security means. And you don't necessarily have to start a fund for that, but you would need to do a syndication, which implies just one property, right?
Got it. Yep.
So what's the difference between the paperwork for a fund and the paperwork for a syndication? Absolutely nothing. Except the fact that a syndication focuses on one property and a fund says we could have several properties. That's it. So how do you analyze whether or not you need to provide this paperwork, these disclosure documents that have the 3 Ds in it? How do you determine that you absolutely need to have that for your investors? Well, first you want to use common sense. If you tell me just your brother and your dear Aunt Sally are the only two investing with you, then I would just have a really solid operating agreement between the 3 of you, or some other contractual agreement. I do not expect you to call me and pay me, $10,000, $15,000 to write you an agreement between you and 2 people who know you very, very well. I've known you since you were born or whatever, right? So we got to be logical about this. But let's talk now that you're taking in dear Aunt Sally and your brother and his best friend and his best friend's cousin and your best friend. And now you're getting more people. These people don't really know each other. They, maybe some of them don't know you as well as others, whatever. That's when you got to really consider, okay, now I have to consider the fact that there's more personalities, more, economic levels here, all kinds of different things. And I got to consider the fact that these people could be vulnerable and I must provide them this disclosure. So that's common sense. Now let's talk about the law. And the law says it's the minute you have 2 people or more. And so it says, and there's a test. So for everybody listening, if you're taking any notes, these are the notes to take right now. The test is 4 prongs. 1, there's an investment of money. So the investors are investing money, not their credit score, not sweat equity. They're investing cash. Number 1. Number 2, those investors expect to receive their money back plus some other money. So profits, interest, whatever it might be, they're expecting something in return on top of their capital. 3, there's more than one of them. All their money, all the investors are putting in their money for the same particular purpose. So that's called the common enterprise. And 4, through the efforts of a promoter, which was to your point, which you said, my Aunt Sally and my brother aren't going to be involved in the deal. You're the promoter, you're making it happen. You're not asking, let's just say it's a rehab. You're not saying to them, thanks for your money, now pick up a hammer and swing. Right. I do want to say this. I see a lot of people or syndicators out there who try to get out of securities laws by making all of their investors do tasks. And I'm going to tell you right now, that's only going to take you so far. The SEC has seen through that. You're not the first person to mastermind that idea. Don't try to outwit the SEC. You will fail miserably. I totally recommend that you don't try to do any fancy maneuvering to get out of securities law. Just follow the law. And doing disclosure documents is the best insurance policy you can provide for yourself.
I like that. And actually, there's another question that popped in, but I had that question I was going to ask you. So maybe a little bit more detail on that. What is something innocent? I say innocent, but simple mistake where you've seen somebody truly go through hell, if anything, with the SEC? What are some of those situations where you had a task to do and somebody got in trouble for it?
I think this is kind of outside of the scope that what we just talked about. But so the 3Ds are disclose, disclaim, and details, right? And disclose is disclose any material facts. And a material fact is any fact that would influence an investor's decision to invest. Now, I will tell you that the person who this happened to was a like very semi-famous in certain circles person. It's not Grant Cardone. Everybody, it's not Grant Cardone. A semi-famous person in certain circles. He was also a very divisive person in certain circles. So he had a lot of enemies. And I was not aware that he had filed bankruptcy in the process of doing his offering. So he filed personal bankruptcy. It really actually wasn't a big deal, but he filed for bankruptcy, did not tell me the bankruptcy was not final. And then he ended up, his offering went live. I did not know he had filed bankruptcy. He had a bunch of investors invest, smaller investors. And one investor put something out on social media that said, I can't believe I invested in this, and this guy has filed for personal bankruptcy. And I was like, we got to disclose that. So we disclosed it, thought we were doing the right thing, totally put it out through the SEC, made a report, did all of this stuff to try to hedge against that potential damage. And no one asked for their money back. Everything worked out. But the day his bankruptcy went filed, 2 days after that, he was served with an FBI subpoena because they were like, well, what else aren't you disclosing? Right. And honestly, that's a complete outlier. I want to be very, very clear. I've never even had another client ever investigated by the SEC, but it was one of those things that just was like, wow, it could happen to anybody. So you really want to make sure that you're disclosing, all of those things that you think an investor wants to know in order to make an informed investment decision. Fortunately, that resolved very nicely. He was like, the FBI said, no big deal. Well, they didn't say no big deal. The FBI would never say no big deal. But they said, we're no longer investing you. We're closing our case. Yeah. But it cost him a ton of money in legal fees just to get through that process because some enemy of his reported him to the FBI and the Securities Exchange Commission. And so these are the things we want to hedge against for sure. Disclose.
Yeah. Makes sense. That's 3 of the Ds, 3 of the 6 Ds now. We had this question asked 2 different ways essentially. And it was pretty much asking, hey, can you have a 506B and a C, 2 funds for one deal? And I think
no.
Okay. I was going to say, I think the genesis of that is like, hey, can I get my accredited investor fund and can I have my Aunt Sally fund?
Yeah, you cannot have your cake and eat it too, friends.
So no to that.
Yeah.
And then we have another question about, it's a little wordy, but I'll try to read through it. Uncles and I are interested in setting up an entity that we can invest as limited partners on apartment deals through. The idea is to pool their capital, have access to more and bigger opportunities. Can we set up a continuous fund and contribute to several deals as they come up? Or would we have to create a separate entity for each deal?
No, you can definitely. I have a lot of clients. We call it a fund of funds, and their whole purpose is to go around and find more passive opportunities for the group as a whole. So yeah, you can definitely do that.
Okay.
Can we talk about the PPM a little bit?
Please.
Yeah.
So okay, we have to disclose. We get that. Now, what makes it illegal for me to write on a piece of paper everything that I think can go wrong and then have them sign that and say, okay, I'm covered?
Well, then you can come have me fix it later.
But
yeah, there's nothing intrinsically wrong with that. I mean, again, when you hire a qualified securities attorney to do this work for you, you're purchasing an insurance policy more than anything else. Because I will tell you right now, I actually had somebody write me last night and ask me, what's the difference between hiring you and hiring, a non-attorney service? And I basically told them, you're going to get what you pay for, and then you can pay me to fix it for you. because that's basically what happens. I see a lot of these, I've seen deals written by other attorneys who claim to be securities attorneys that are complete messes. Because, for example, and this is a huge thing, and anybody out there who's thinking about being a passive investor, or even anybody who's not thinking about being a passive investor, but raising money for your own fund or for your own syndication, the big problem I see is the operating agreement doesn't match the private placement memorandum. Like the attorney just does not know what they're doing, or you get a private placement memorandum from one source and then you have to provide your own operating agreement and you don't know how to get them to match properly. So this is really why you don't want to take that approach, because you want to make sure that if an issue ever comes up, it is abundantly clear on what to do. I've been doing this for a really long time, and we are seeing problems in the economy just starting, and I have documents that I believe are super clear, super straight to the point, and we still get questions. I can't even imagine getting a document that's so confusing you have to hire 10 attorneys to interpret what's really going on. So, yeah.
Okay. I think the answer to this I know, but I want to, somebody had asked this at one point. Size of deal, does it matter as far as creating a syndication? Like, I mean, can you syndicate a single family home all the way up to a $20 million property, or does it matter? I'm just curious.
It doesn't really matter, except for the fact that, again, I say use common sense. The smaller the deal, the less likely you're going to call a securities attorney. It's like killing a bunny with a bazooka, right? You don't really need to do it. It's not necessary. So, and my brother who helps me with all this camera stuff hates it when I say that. He tells me, "What did you tell me the other day? You feed two birds with one scone." Don't ever kill animals, in other words. It's a terrible analogy. So I got to find a better one than bunny and the
I like it. I think it's a good one. It makes sense. Very visual, but it makes sense.
So what I'm trying to say is you want to use common sense. What we always tell people is like, look, if you're raising more than $500,000 or you have more than 5 investors, you really need to consider calling a securities attorney to help you out with that. That's number one. And that's not the law. That's just our, again, common sense type of rule. The second part of that is if you're raising capital and you're out there for single families, unless you're raising money for like a single family home in Silicon Valley or a luxury home wherever, like it doesn't really make much sense to raise money for one single family. What I usually recommend people who come to me with single family deals is do a fund. Just do a fund and then do as many single family deals as you can in a 1-year period. That's generally how I encourage people to do it.
Do you see that now? Syndication has become very popular, especially in the last 5-6 years, probably, as people are sort of saying, hey, I bought a bunch of deals after the recession. I don't have any more money, and I need to raise capital. It seems like that's the path. But with everything else that's happening now, I think of like Airbnb, some of the short-term rental companies that are popping up. They're doing, like, what other applications are you seeing, if anything outside of just your standard and buying this 120 unit apartment building, where a syndication, a fund is applicable? I'm just kind of curious. So we have people that do a lot of different things, and I just wonder if you're getting fund requests, if you will, for other types of asset classes or other types of businesses in the real estate world.
Yeah, self-storage, huge, mobile home parks. So single family, I'll be perfectly frank, we don't do a ton of multifamily funds per se, except for in the Reg A space. Most of the multifamilies that come in are syndications. So it's one deal, one property, 1 ppm, and then the clients, generally speaking, do them over and over and over and over again. Like they'll do another syndication, another syndication, another syndication, as opposed to doing just a fund and going and buy properties. So that's because that's their marketing style. They prefer to market the deal to their individual investors. So they'd rather spend the money on the legal fees each time so that they can go out and say, would you like to invest in this particular deal? But yeah, you know what I'm not seeing a lot of right now, but I fully expect to see in about 2 years from now, note funds. I used to do a ton of note funds, just tons of them. I felt like I was the note queen at one point. And now I don't see a lot of them. We don't have a lot of foreclosures. We don't have a lot of opportunity to buy cheap notes, performing or otherwise. So, and also it doesn't really make much sense because interest rates are so low.
Sure.
So it just doesn't, that doesn't jive right now, but that will, I believe, become a thing in about 2 years.
Okay. Well, you mentioned a moment ago, it piqued my curiosity because I wonder how this would work. I have a syndication on a multifamily property, right? I have a fund, I guess, associated with that property. I pay the fee to you to create everything I need to fund that deal, right?
Yeah.
For those that might, and it sounds like some do, create a fund and fund multiple deals out of that fund, non-Reg A.
Right.
You can do that outside of Reg A, right? C or B?
Absolutely. Yeah, absolutely. All the time.
I would guess that the risk with that would be, or not the risk, but the challenge with that would be, if you got 4 or 5 deals going at the same time in a pool of investor capital, how each investor gets their return. So how does that work? Or how do you, I'm curious, how do people manage that?
No, that's a great question. Okay, so the first year is obviously going to. This is what I always tell people because people go, but the old investors, were the first ones who came in, so they should be treated special. Well, they are. Time treats them special in 2 different ways. 1, they're getting returns throughout the year, and then 2, at the end of that first year, they're going to get pro rata greater returns throughout the year. So because they were invested from January to January, as opposed from somebody June to January.
Okay.
So for example, like if I invest in June or July and I run through the rest of the year, then I'm going to only be entitled to 6 months of returns. I'm not going to be entitled to 12 months of returns. The old investors, all of those that invested in January, will be entitled to 12 months of returns. Not only will they be entitled to 12 months of returns, if there's a preferred, they'll be entitled to the preferred for the time that they're in the fund. Same with the new investors. They'll be entitled to the preferred for the time that they're in the fund. And to my point, new investors need old investors as much as old investors need new investors. Actually, I'll say that in reverse. Old investors need new investors as much as new investors need old investors. And what I mean by that is that old investors can't get into new deals unless they have new money. Their money can only be used once to get into a deal, right?
Okay.
Once it's there, if they want to get into another deal, they either have to pony up more money or new investors have to come in. So the point is that, they both need each other in the fund situation, and they're both treated accordingly based on the time that they invest for that first year. I mean, this is assuming we stop taking investors in December. Like we're done taking investors in December, then all things are equal after that.
Okay. So that's good to know. So it's not that you would maybe, and tell me if I'm wrong, it's not that you would raise a bunch of capital and dump it into this fund and then put it wherever you want to as deals come in. You would raise deal by deal within the same fund. Is that a fair way of putting it?
Right. Or, I mean, it just depends on what your model is, right? You could raise money as the deals come up, or you could just be raising money on a continuous basis. But if Joe invests in January and you buy a property in February, Joe's money is going to go into that property in February. But Joe's interest has nothing to do with that. I mean, it has a little to do with that property, but Joe's interest is going to be spread across that property, the property you buy in July, the property you buy in December, even though Joe's entire capital was used for the property in February.
Got it.
You can only use somebody's money once.
Okay.
But they're all going to have an interest in the same property. Now, if dear Aunt Sally invests in June, right?
Yeah.
Her money's going to go into the property you buy in July, but she's still going to have an interest in the property in February and the property in December. So they all have it, but her interest is going to be prorated over the year because she came in at June. and Joe is coming in at January.
That makes sense. It's complex, but it makes sense. You know, like it sounds like I see why most set up.
After the first year, it's all a wash though, because they all catch up with each other.
That's true. That makes sense. So you muscle through the year and you only spend money once to file a PPM, essentially, correct? And by the way, Aunt Sally's, she's well diversified. It seems like she's putting money everywhere. She's just spraying it wherever she can go.
Well diversified for an unaccredited investor.
That's right. Good point. Good point. Who does all the accounting for that is a question we have. Is that does your firm do that?
You put it in QuickBooks. Every investor should have, I'm assuming you use QuickBooks. You can use any software you want, but each investor is going to have an equity account in your equity line on your balance sheet, and you're just going to keep track of it there. And then at the end of the year, your CPA will help you figure out your K1s. And by the way, there's two things you have to have: a really good bookkeeper and a really good CPA.
Okay. What's the point at which people should come talk to you or somebody like you? Meaning, all right, I own a few properties I've JV'd on, and I'm thinking I want to step up and do a syndication for my next deal. And I'm active, I'm planning to do it or whatever. Do I come see you then and start to form the relationship? Do I open a fund at that point potentially? Or am I waiting till I got a deal and then I'm going to go, talk to you about how I can structure a syndication to raise capital?
Great questions. So you don't really, okay. So if you're going to do a syndication, you want to call me at LOI. So don't call me before LOI. You're just going to irritate me. You're going to have to call me at LOI too.
I love it.
You call me at LOI. We get you set up and going. In the meantime, I'm not going to leave you high and dry. In the meantime, you can go to our website. You can find all kinds of free stuff. Our YouTube channel has tons of free videos on it, and you can find out all kinds of stuff. So that's number one. If you want to do a fund, you can call me anytime for that. It's just a matter of are you ready to move forward? So yeah.
Once you have LOI, once you're under LOI is when you get an attorney involved is what you're saying, essentially.
Basically, yeah.
Okay.
I mean, if you're doing a fund of funds, you can start that anytime.
Right. So if that's your intent, right? The model we just talked about where you create a fund and you plan to have multiple properties funded from that fund. It's a lot of funds.
Yeah.
That you could do at any point, pay you for that. Just curious, run of the mill, what does that cost somebody, range, if you will?
It's really about how much you want to raise. I hate to be evasive about that, but our average client spends about $15,000.
Okay. All right, perfect. That was one of the questions that just popped up as I was asking.
Yep.
So,
but
all right, we got a couple minutes left.
To get a quote first before you take that because it could be less, and we give a pretty significant discount to people who are raising less than $1 million.
Gotcha. But okay, yeah, it's kind of I hear in that range, 12 to 15 to 8, somewhere in that range is typical. So that makes sense. Okay, we got a few minutes left before the top of the hour. So I was curious. I'm just going to ask this question. What's this music career that you had prior to? I wrote it down. I'm sorry. I know we're talking syndication.
No,
all this
that's
stuff,
fine. Oh, I love it. No. So when I was in college, I actually met my husband because he was the booking agent at a club and I was in a rock band, and I was a bass player in a rock band, and I thought I was going to be a rock star. And then my band broke up and I really never found a new band that worked for me. So I instead started managing my husband's band and running a record label. And we did that for a while, and we went on tour, and he opened for a bunch of big famous bands, and he was like famous in South Africa, but we had no money. See, the music industry, let me explain, kids. The music industry is one of two things. You're either super famous and make tons of money, or you make nothing and you can't pay rent. And we were here.
Unbelievable. What bands did he tour with, if you don't mind me asking?
He opened for a band called Sum 41 that was like famous in the 90s.
I remember Sum 41.
He opened for the Foo Fighters. He opened for Cheap Trick. I'm trying to think of who else right now, but those were like the three big, huge ones. And then he opened for some like metalish type bands that were famous in the 90s as well. So he did some really big things, but it did not translate into dollar bills, y'all. So,
well, you became a rock star in a different way, right? In the regulation.
So Jillian was sick of eating dollar burgers on the McDonald's dollar menu, so she She went
Aren't
to
we all?
law school instead.
Or weren't we all? Absolutely. All right,
Speaking
there's
of
a
being
lot of requests for this.
That's
What's
what
that, Ben?
I said, speaking of being a rock star, the book behind you is kind of being a rock star right now.
Yeah.
Everyone wants the email address to get a copy of the book.
Oh yeah. There's a way people can, you know what, do this. If everybody sends an email to crowd@crowdfundinglawyers.net, that's going to send with the subject line helpful chart. We'll get all those emails, and then I'll have Lauren, who's not here right now, I'll have her get the book out to everybody. So crowd@crowdfundinglawyers.net, subject line helpful chart. And the reason why that subject line is so important, because it's going to send you an autoresponder with a helpful chart in it, literally. So that will and you'll like that. You'll like that a lot. That will be a good primer before you get the book. I'm telling you, I'm going to be perfectly frank with everybody so nobody gets disappointed. This book was written in, I think, 2015. So some of the laws have changed a little bit, which is why I really don't want you to buy it, but the content is still good. So enjoy the book. If you like it a ton, please write a nice review on Amazon. I would be very grateful.
Absolutely. Absolutely. Now, this is great. You mentioned the YouTube channel. Any other places where you want folks to go to check out some of your content?
Yeah, check out, if you check out Private Money Rockstar, we have 1-minute videos there that give you, Private Money Rockstar, go to Facebook for that. Private Money Rockstar, check that page out, because we release a new 1 to 2 minute video every week that gives you, quick tips on how to raise capital. And there's some marketing things in there too, like on how to, not just the legal aspects, but what's been successful for clients and stuff like that.
Excellent. You have a podcast coming out too, do you not? Or am I not supposed to reveal that?
Oh, you mean with Jeff?
Yes.
With Jeffy Jeff? Yes.
Jeffy Jeff.
I am so excited. This is outside of real estate and law and raising money, guys. So I just want you to know that in advance. It's called Last Life Ever. You can find us on Facebook, where we stream live at 4 p.m. Pacific time on Mondays. And we just are trying to bring you things that will make your life amazing and awesome and give you ideas on how to live an amazing life.
Excellent. No bourbon?
No. Please, him and his I went on that old-fashioned real estate show, and I walked off of that old-fashioned real estate show little to my right.
I'll be honest, I never had them before until I heard of this show, and I tried an old-fashioned. I'm hooked. I'm hooked. They're good. They're really good.
I'll tell you, I couldn't believe I got through, because I don't drink brown liquor like that. Don't worry, I do plenty of drinking, but I don't drink brown liquor. And I'm not going to lie, I was sweating bullets before I drank it, because I thought I was going to gag, but it went well. It was a very well-made old-fashioned.
There you go. Only the best from Jeff Holst. I love it. So, Jillian, thank you so much. I appreciate your time. Sorry about the stuff in the beginning and everything.
Oh, no, I'm sorry. And thank you, everybody, for hanging around and asking questions. And if you need anything else, you know where to find me, crowdfundinglawyers.net. We're all over the web. You can find me, and I'm happy to answer any other questions you might have.
Beautiful. Well, thanks again. Have a great evening. Thank you to everybody. Thanks for participating tonight. Ben?
A bientôt.
Yeah, what he said. All right, we'll see you guys. Thanks, Jillian.
Thank you.